Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. Welcome back to another episode of Wealth Wisdom, brought to you by Fox Hill Wealth Management. With me today is Bill Ryan and Eric Benz, principals of Fox Hill Wealth, and I'm your host, Justin Obi. Today, we are talking about mortgages, specifically what you should do. Should you pay it off early and, get mortgage free, or constantly refinance when you can and use those funds for other things? Before we get into it, let's go through a quick rapid fire market update, and then we'll jump into the main topic. This week, what do you guys, I feel like it was a quiet week this week, guys. Powell and the Fed kept interest rates the same for the third consecutive meeting. It was expected. Everyone thought that. Do you guys think they're going to capitulate and start to...
Trump didn't think that, but yeah.
Yeah, I do. I was cracking up at the headline. He was like, oh, it's like talking to a wall about Powell. Yeah. But
I think they're going to...
Relatively quiet, down a little bit. Market was down slightly earlier in the week, rallied with the UK-US trade deal news. The big thing everyone's waiting on is news about China, right? No one really knows what's... Everyone assumes stuff's going to get reduced from where it is. Knows what that's going to be, though.
Yeah, 100%. It was just, at least I kind of figured, like, with European nations and stuff like that, that stuff was going to get worked out, right? But China's obviously the big number, right? The 145% tariffs, all this stuff, the back and forth, tit for tat. So hopefully that we're at least moving in the right direction. We'll obviously see what happens, but that's a big one. That's the news that the market is eagerly anticipating because, like you said, Justin, most people, most pundits and everything like that had us doing nothing with interest rates, which I kind of agree with at this time. I think that's going to be more. We'll see what happens with some of these other things, and I think that's going to dictate where interest rates go. So, and I think Powell, he's just looking at data and he's just holding steady. He's like, until I get a little more information, I'll make decisions. Until then, I'm not doing anything. So, too much uncertainty for him to make any decisions.
Well, uncertainty was the word. I think someone said if you were doing a shot every time Powell said the word uncertainty, you'd be on the floor in his speech. So I think they have a lot of patience and they're waiting, like you said. So we'll see what happens. I personally think
they can act quickly. Like we saw it in COVID. When the time comes, they can act very quickly and almost too much in a sense. So I'm not worried about what they're doing.
Right. And then they announced the US-UK trade deal. That was, the first of many trade deals to be, officially announced, it seemed. But it seems like also details are coming through. I think we have a couple highlights here, but...
Yeah, I was going to say, what type of stuff are we talking about?
They're keeping in place a 10% blanket tariff. And then on vehicles, that was an interesting note in the agreement. The first 100,000 vehicles from the UK are at 10% tariffs, and then it jumps to 25% after the 100,000, which is, I think some car manufacturers were fine with, but I don't know. It's interesting. And then there's a lot of like making trade easier. It seems like.
Do we have any information on
how many vehicles are even coming in? Yeah, that's from the.
I don't know. That's a good question.
That's just one thing we should look into a little bit, because that's one thing that interests me is like, what's the reciprocal? Like, what are we looking at? So,
we have a surplus with them. That is what I read as well. So, it's
So get your Jaguar or your Rolls Royce now.
Right. Yeah. There was another, what was the other car manufacturer they were like trying to resurrect, but it wasn't Range Rover. Is Range Rover made over there? I don't know.
What's the Formula One brand? McLaren?
Oh yeah. Get yourself a supercar. Great.
Yeah. On the market for that yet.
I don't think I'd ever be.
Here's Martin, Bentley, Rolls Royce, Land Rover, Jaguar, Minis.
Land Rover. Yeah. And Land Rover's really trying to come back, and they were fine. They were happy. I guess like that news about the first 100,000 was a good bullish thing for them. It was going to help them. is the headline. So I mean, you guys saw Google fell this week as well. What do you thoughts over there? What do you think of Google?
And that was the Apple news, right? Apple's
Yeah.
implementing an AI into their Safari search tools. I mean,
It's like more search to client fears.
Yeah, they're facing competition everywhere now, right?
Yeah.
ChatGPT, Claude AI, Apple's doing their own thing. People search on Facebook, people search on Amazon, people search on TikTok. So rightfully so, people are starting to get concerned about Google's monopoly. Government stepped in too late. Anyways, competition worked itself out.
Yeah, I actually found you.
Yeah,
I was just going to say that like an Apple executive was saying yesterday that like searches on Safari itself are down considerably. You know what I mean? So they had like actual data showing that like it doesn't matter that Google's the default search engine there. The searches themselves, like the actual number, are down, right? So
yeah,
that's a very telling stat there.
Yeah,
the hits just keep coming for Google. I mean, I think there's a lot of good things about it too, but yeah, the hits just keep coming for it, So.
Yeah. Well, a lot of people are using ChatGPT for searching, and TikTok
what are
now.
your kids
TikTok is
using,
quickly
Justin?
becoming probably YouTube. I think they're all YouTube.
Yeah.
Yeah.
Well, that's Google. That's Google products, so that's good for Google.
So it is a good. Yeah, I mean, you can't. I don't think you can count Google out. I think it's actually a good thing.
I don't think you
think
can either.
a lot.
I do think they have to do a much better job of like getting their Gemini product, like getting it infiltrated into the market, right? Because it's a really good product, but they got to like push it more. I'm not sure how. Like, obviously, I don't know. You know what I mean? How they should handle all that stuff. They really got to get it out more, get it out in front of consumers more. Got to get it. You know what I mean? That's a big thing. They got to get it out there more. I think that, and they always kind of struggle with that. I've often said that all their products I feel like are like the best on the market. I think Gmail's the best. The Google Suite I think is much better than everything else, but it's never really had that penetration that like Microsoft has had, and you know what I mean, things like that. So it's interesting why, you know what I mean. But I feel like they always do have the best stuff, except for Excel. I like Excel better. Yeah, but.
I like Excel as well.
Yeah. Google Sheets,
much better, more powerful for sure.
Yeah, but everything else, right? I feel like I feel like it's a better product. I like the email better. I like, you know what I mean, things like that from Gmail. Just don't seem to have that like market penetration, and they really need to do it with Gemini. They got to get, you know what I mean. Somehow they got to get it out there, or really spread the word. Either do some type of vast marketing campaign, something, right?
Well, they're inserting it everywhere already, so. Yeah. It's, whether you like it or not, they're rolling it out.
Yeah, the Gemini is more prominent on Google search. It's just gotten more and more prominent, and I'm not even scrolling down. But is that hurting their ad revenue dollars? If you're not clicking the sponsored links below, they need to figure that out.
I'm sure it is.
Yeah,
but they can figure out a way to roll that into the AI too. That's another thing they can do, right? That's a
Right. It's interesting. I think their interface is not good. The other thing they're battling is consumer behavior, right? Like more people have been already training themselves to go to ChatGPT first. So I think when it comes to AI,
it's on everyone's phone.
Yeah, it's everyone's phone, right? People are now talking to ChatGPT as their therapist. Like I know lots of friends who are asking ChatGPT as like, hey, what should I do here? How should I talk to my spouse about this? Like, I'm going through these issues.
Sounds like it's hitting a little close to home, Justin.
No, it's real.
You're like,
like this is.
He's talking about.
I love Chat. Me and Chat are best friends. Best friends. Yeah, he guides me through everything. No, I'm serious. This is talking points headlines on the news. Right, it just came out. Like more and more people are using this as a therapist. So it is very interesting. There's incredible how people trust it so much. Right, like some people are literally telling it everything, and I don't think that's good. But I mean, basically, if this is the first version, you're gonna have. There was another headline in the news of humanoid robots, right? I think it was J.P. Morgan, or I forget. They said it's gonna be multi-trillion-dollar market, right? And those robots will be enabled with artificial intelligence. And you will be talking to it like your best friend. That's by 2050. It's insane. I know. That's what they're projecting by 2050.
I don't
So.
know. I feel like that's like a lot of.
Could be.
Yeah, that seems like you click like the clickbait article. That's yeah.
It was in CNBC the other day.
Yeah,
I mean, I'm sure there's a certain.
I'm just here to read you the article.
maybe
Yeah.
that stuff is available by 2050, but I actually like roll it all out and
I think that maybe there's a certain sector of the human population who might do that, but I also think there's a lot of people who that's not going to fly.
Yeah, Morgan Stanley. Morgan Stanley projected a staggering $5 trillion market
I would bet
for
that'd be a
humanoid
massive
robots.
pushback. People like, I don't want that stuff in my household. I don't want that stuff.
No, it's gonna fly. You're gonna have a robot payment. You're gonna have a car payment. You're gonna have your car payment and your robot payment.
Yeah. Oh yeah. No, I don't doubt that. But like, I would almost lay a premium to have a robot that'll just do chores and things and not pretend to be a human. Like that would freak me out. Like, hey, offload a bunch of tasks, but
Yeah.
I don't want you to be my best friend. Yeah. I don't know.
This is gonna be wild. We'll see. It's crazy. You know, our parents, I think the worst thing they had was like calculators, right? So like you'd ask you're like, why do I have to learn math? I've got a calculator. And now it's like,
Why do you have to learn to do
why do I have to learn anything? I have got AI.
Yeah.
It's insane. But anyway, moving on. Next headline. Just back to cars real quick. It's interesting to note, you know, consumers are rushing to make car purchases right now. So used vehicles are found very interesting. Surge to the highest level since 2023, just in fear of tariffs.
Well,
know what you-
imports surged too. That was the whole thing. All these companies front loaded. They're like pulling in after the tariffs came in this
To get them over.
quarter.
Yeah,
That's in-
Bill Ackerman actually like put a huge position in Hertz under the belief that, you know, they have a huge fleet of vehicles. With that huge fleet of vehicles, right, with a surge in cost of used vehicles, right? He believed the valuation was like undervalued by a certain amount. Hertz stock doubled basically after he, you know what I mean? He announced that reason and things like that. He will do that though. He'll take a position. He'll put his reasoning out there on why he does it, which I think it's really interesting. And yeah, I mean, you saw him.
Yeah, it's a little bit of market manipulation, kind of.
Well,
right?
he's stating
It's like when the
why he's
short
doing it.
sellers, like, yeah.
Yeah.
I mean, he also has
That's
a
it.
very large position in Google, and he, you know, at least
Yeah.
as his latest 13F, and he also has a large position in Chipotle, both of which have not, you know what I mean, have struggled a little bit lately. But yeah, you know what I mean. It's just something to think about. I like his rationale, right, on taking something like that, seeing the other value, see how it's going to be affected by tariffs, seeing how that, you know what I mean, like the value of their underlying assets is going to appreciate exponentially, right, based off what's going on. And done pretty well due to it.
Yeah. Yeah, that's interesting. All right, so on to the main topic. I think it was, I mean, we had this on, maybe it was a month ago or something, but someone asked like, hey, I really want to pay down the mortgage, right? It brought me to this, you know, I want to dive in, hear what you guys think. There's a lot out there on social to say, you know, you should pay it down or you shouldn't. But should you pay down your mortgage early or do more investing outside? What are your guys' thoughts? What are you advising? You know, are there different scenarios, sorry, depending on your age? What do you guys think? Eric, what do you think?
I just want to go on a rant about Dave Ramsey real quick. I feel like I get we're in the space, financial space, so we get targeted with this stuff, but I see like clips all the time about, you know, pay off your mortgage, get rid of that thing, all this stuff. And I feel like he's doing it for clickbait and he's a moron. This is Dave Ramsey we're talking about. Because
He's very against debt.
To make a blanket statement like that, like,
I was going to say, is he against mortgage? I mean, is he for mortgage payoff early, or is he all other consumer debt?
I think at least the headline is implying it's early. Like,
Okay.
I would assume he would say obviously say get rid of the credit card first.
Right.
I know he's
He's
very
really-
against. I know he's against auto. You know what I mean? Big auto debt and credit card debt. Obviously,
Hey, auto debt though.
he doesn't believe in buying an expensive car. If you finance a car, he thinks that's the worst thing you can be doing. Well, you're paying interest on a asset that you really can't afford.
Depreciating assets.
Yeah, depreciating assets. So he's like Get something that you can afford to pay in cash.
Yep.
And that's what you should be driving. If you can't afford to pay for it in cash, he doesn't think that he thinks it's a lousy use of your capital.
Well, I mean, he doesn't.
It makes a
I
lot
don't
of
think
sense.
it's a bad point.
I mean, yeah, exactly, right? You're basically living beyond your means, is his
The-
take.
There's a lot of people who buy
Get a-
cars
you can
to
get a-
impress others.
My rate for my car payment isn't much different than my home payment. Like, it's not. I feel
His
it's not
argument,
Or your rate.
Eric, is that instead of
Yeah.
financing that car for $30,000 or what, you don't even whatever, you should be paying, paying $12,000 for a used car. Use that car for 6-7 years.
Right.
And that's his take. By the numbers, he's not wrong. You know what I mean? Like, if you look at like doing it rather than taking that capital, applying it to a car savings, you would be better off investing that money. And there's
100% better.
You
You said.
can draw up every Excel sheet,
Right.
in which way. He is right. I'm not, you know what I mean? Like, from that perspective, he is right. We only live once, though. It is nice to drive.
Yeah, I think the assumption is lifestyle's not important at all,
Right.
which is totally, not true.
That's the thing. I mean, I'm definitely, in terms of like, if you talk about a car, go with features that you like as opposed to you know what I mean? Having to pay for the expensive thing. Like, if you live in like the Northeast, having heated seats, you know what I mean? And, things like that is more important to you. Like, I would go more for the features of the car that you like, the features that you want, as opposed to the car that you want. Getting that level, whatever, right? It's, like you said, Justin, you're almost doing it to impress people, not necessarily like for the practicality of it. You know what I mean? And then in terms of building wealth, you don't want to be overpaying,
Right.
right?
Well,
That money.
If you don't have a lot of car payments now are, between $500 and $1,000 a month. So, I mean, that's real money you could be investing every single month if you don't have that car payment. So instead of buying, like you said, Bill, if you buy a $5,000 car, used car that gets you from A to B, fine. It's fine. It could be fine. Or you just hold your car longer.
Pay for in life too.
Well, there is something to be said for just buying a car that's a solid car and owning it for 10 years, 10, 12 years and
Toyota.
flexing that. Yeah. Yeah. There you go. Well, back to the subject matter. Like, we're not cars. What are you going on? What's the rant? Let's hear it.
All right. I just hate seeing that content from Dave Ramsey because it's blanket. All right. What are the advantages of paying off your mortgage early? You get a guaranteed return equal to that interest rate, right? So if I'm paying a 6.5% mortgage right now, boom, pay it off. I'm guaranteed to be like making that 6.5 a year, for instance, right? Peace of mind of being debt free, reduce monthly expenses, and then some protection against like housing market volatility. If I'm taking all that capital, putting it into a house, I'm seriously reducing my liquidity. If I want to then take out cash against my home, that's going to be at a variable interest rate. If interest rates go up, I'm out of luck, right? That could, we saw a balloon up like 8%, this, past couple of years.
Oh yeah, mine was up at one point to I think it was like 8.125, and I was at prime minus 0.75% was my home equity line of credit. I know people.
That's actually a good rate.
It was prime plus for a lot of people. So
right,
you're probably paying 9+%. You know what I mean? Things like that. So.
And when they originally took an equity line, it's probably at like 4 or 5%, right?
Yeah,
maybe a little bit more, but yeah.
Right.
Yeah.
So there's a big disadvantage having that fixed rate. And if you get in lower, a lot of people got in, from 2010 to 2020 at like a 2-3% interest rate. It's fixed. When interest rates balloon up, that itself is an asset. Like I don't see an advantage in trying to get rid of that. What else you lose? You lose liquidity, like I mentioned. You lose that interest deduction for taxes. And then the big one
it is minimized a little bit under the current tax code. Prior to 2018, you really were like looking at like, all right, what's my rate? And I'm really only paying, 1 minus my marginal tax rate, right? You know what I mean?
Right.
Like whatever that equals. So you're paying, let's say your taxes are about, 20% or something like that. You're really only paying 80% of that rate, right? Because you get to write the tax write-off. But that's not as prevalent as it once was under the current tax code. So That's you know what I mean. That's something to think about. You do get to write off a little bit of it typically, but it's minimalized in today's environment.
Yeah.
You know, so.
But when you go back, okay, the clear disadvantage, which I assume you would agree with, Bill, is when you put all that money in a home, that means you're taking it out of your other investments, which if you're invested in the stock market, historically over 100 years earns 10% a year. Last 15 years has been 15% a year if you're invested in all stock, which will clearly be that 6.5% rate that you're getting hit on the mortgage. If you invested conservatively, then maybe you have an argument. You're like, hey, I can't handle the volatility of the stock market. I'm invested in like 70% bonds, 30% stock, and I'm really only getting 7% return anyways. Maybe you put more into the mortgage. But otherwise, the clear advantage is to have the liquidity and be invested in the stock market.
Numbers, right? Basic numbers. You're leveraging the asset through a debt instrument, which is your mortgage, and you're hoping to get a difference in that rate of return, right? So, that's one, like that's just from a pure numbers perspective. It's gonna, like you said, make that you're gonna come out on top on that, right? The other thing too is just like you said, is I just like it like the liquidity aspect, right? You're better with the cash on hand than you are than putting it into giving it to essentially the bank. The value of your house is going to go up or down no matter what, right? You could have 80%, you know what I mean, financed, or you could have 5% finance. Like, you know what I mean? That's it. Like, that's all you owe is 5% of what the house is. Your house is going to go up or down. Like, it doesn't, you know what I mean? It has zero effect on that, right? So you don't like look at a house and say, oh, this house has a big mortgage on it, I'm going to pay less for it, right? You know what I mean? Or something like that in terms of buying it, right? Buying it. So my thing is allow it to just grow and then make the difference on it, make that difference in interest, right? So if you have a 4% mortgage, I'm not saying today's environment's a little different, right? You're not going to get a 4% mortgage. It is closer. Yeah. And it's going to be closer to, so that question's going to come into play a little bit more, right? If you pay down the mortgage but I just, from a perspective of having the cash on hand, when you own a home, guess what? There's a lot of big expenses. Okay. So, your furnace goes, wouldn't you rather have that money on hand? You know what I mean? So that you could say, hey, let me sell off this stock and pay for my furnace. My siding is like deteriorating. I need a paint. I have decking that's rotting. I have, you know what I mean? Things like that. You're better off having that money on hand than, again, taking it out of, consumer debt, taking a home equity line of credit, like you said, all the risks and stuff like that, you know what I mean, are there. I mean, you have the ability to. A lot of times you take out a home equity line of credit because you need it in an emergency. You need it for, you know what I mean? Something like this happens. Yeah. Your heat goes out.
It's a cushion.
You need to fix that thing right away. You can't, you know what I mean? Like, you can't be like, oh yeah, I'm going to put that off. You can't put off.
Right.
You know what I mean? Getting your heat fixed. Like, that's good. Not having that in is going to result in,
of course, you need
burst pipes and things like that are going to be exponentially expensive. You need to do those things. So you'd be better off having the money yourself. You know what I mean? And enabling you to then take care of those expenses. So having that liquidity, that is, to me, that's worth it. You know what I mean?
Yeah.
But if it's not, well, is it really liquid if you're using that money to invest it in stocks, right? Like, how would you guys play? Like, would you keep, a couple months
money
cushion?
That money in your account is in your account in 2 days.
2 days. Yeah.
So
if you sell stocks,
that's what you mean. Traded. Yeah. Yep. Settlement.
Right. But we always say, like, you don't want to have to sell in a bat, like, for an emergency, right? So, like, do you know what I'm saying?
I 100% know what you mean. But
so, like, would you have some money in a high yield savings account for a little bit?
Normal market conditions. Like, you're talking about, stuff tanks, right? You don't want to be in a position to sell. Certainly. We want to have an emergency fund, 3 to 9 months, right, of cash of your expenses. Now, that's not always credible for a lot of, you know what I mean, for a lot of people. But yeah, I think 3 to 9 months of your expenses.
Or you can have a home equity line that you can tap into for those. Maybe, I don't know what you would say.
You can. It just comes with
I don't know,
with
some
certain
risk,
other risks,
some debt.
things like that.
Yep.
Yeah.
Right.
I just wanted to clarify that for everyone listening, because I think, and then is there a way to kind of do both, right? I always view like the mortgage, it's like a forced savings account in a way. You have to pay it. You're paying down, you're gaining more equity in your home every time you pay that down. And then if rates are in the right environment, right? So if rates historically, just before this past 2 years, rates were always coming down. So it allowed a lot of people to refinance continually at lower rates and even do cash out refinancing, pulling out money tax free. That might happen again if you bought an 8% rate and rates do come down. Yeah, tax deferred, you're right.
Yeah.
Well, is it tax deferred as much on your primary?
I mean,
We were talking about that last episode on like for investment vehicles. But is it, could you,
250,000 or 500,000? If you get a 250,000, if you're single, right? To
per
gain,
couple,
like in real estate,
per person?
$500,000 for married filing joint, right? Is it
Right. So
tax-free?
some of that could be tax free. I'm pushing it a little bit.
Yeah, it could
Yeah.
under the current law. Yeah,
Okay.
certainly.
So, there is a distinction between what we were talking about last episode. If you guys were listening, if people were listening to that, we're talking about investments, like real estate investments versus your personal home.
Right.
Yeah.
So,
So there's different rules, right, on the sale of how that's handled.
yeah, I just wanted to clarify for everyone listening right now.
Yeah, you're
just to hear
pulling
that.
out some of that gain in advance, right? If you do a cash out refinance, right? So
Especially for an investment vehicle.
Right.
Right.
Dude, I just think I just want to
What
go back
about-
to Dave Ramsey and how he's an idiot. Because to preach a debt-free lifestyle is just another way to make sure that people don't become rich. Like this
Yeah, I
way
agree.
there's a balance.
But it's got to be it's the right kind of debt.
He should be preaching a no credit card debt lifestyle.
Yes.
That I don't know, maybe no luxury cars, but every billionaire takes out debt. Investors take out loans against their own assets to buy more assets. It's a compounding thing, right? Elon Musk, the richest guy in the world, takes out debt against his companies to purchase more companies. That's how you make money.
Sure.
Home debt is great debt. That's the best debt you can have. I just fail to see why you would ever want to pay it off early. And for Dave Ramsey to preach that is insane to me.
Well, I think he's talking about the average consumer, right? The average person probably doesn't necessarily understand or handle debt, you know what I mean, the best way possible.
And you get them advisors.
He's giving them
advisors.
right, absolutely. You want an advisor who can help you with that and go over that, who understands finance and leverage and making sure, right, that there's cash flows in place to cover those debts, right? Because if you don't have the cash flows in place, or there's going to be some type of change in your cash flow, that could result in putting you in a not so great financial situation, right? Then that's a problem, right? And I think what he's trying to do is kind of make a blanket statement, right? He's taking away the nuance and things along those lines and saying, just don't have it. If you don't have it, you don't have to worry about it, right?
Right.
But like you said, like anything, any business, right, is going to use debt to then use that money to make more money, right? And as long as those cash flows can pay off that debt and interest and also have a margin on top of, that's a good thing, right? And that's what you're kind of doing with your house. You have an instrument, you need somewhere to live, right? So the alternative is, right, you either have to rent, you're paying a rent each month, etc. So you're then taking that money, from your job, you can pay that off. And then you're taking your leftover, you're investing in something that hopefully is going to appreciate in value more than what that debt payment is.
Right.
And that's, that's what you're trying to do. And as that money compounds, right? So even if the difference is, say, 3-4% over what your mortgage is, like let's say right now you take a loan out, you have a 6.5% mortgage, but you're then taking, rather than paying that down, you're putting it in the stock market, you're gaining 10%. 11%, you know what I mean? Something like that. You're making that difference. That difference is compounding, right? Over time. So now you're making 3.5. You know what I mean? 3.5, 4% compounding over time. That's building your wealth up. You're going to accumulate more wealth if you look back in 15 years, right? That money that you're putting away, that $200, $500, $1,000, $2,000 a month is now, right, compounding that 4% difference. And, next thing you know, you're 40, 50% wealthier, right? 15 years down the road. And you have that cash, and you can then just pay off your mortgage at that point, right? Say you're almost at retirement, you're like, I don't want a mortgage payment in retirement. It's actually going to increase how quickly you pay off your mortgage, right? You're just not doing it every month. You know what I mean? That's the thing. You're using the long-term appreciation of the markets to your advantage, and you're leveraging the debt that you have on your house in order to do so. That's why it's
Right.
A lot of people, again, looking at long-term financial planning, right? Most people are concerned about what's going on this week, right? Or what's going on this month. That's what they're concerned about, which is completely understandable. It's tough out there. But just having a little more foresight, a little, you know what I mean? A little more, pro forma outlook of your finances. And you can see that it definitely makes more sense to invest the difference. But you want to make sure that you, again, have your emergency savings in place, right? You want to make sure that, everything else, all those other pillars are in place, and then start doing it. And if you can do that, it makes a lot more sense to invest the difference as opposed to paying down your mortgage,
Yeah, completely. So big, there's a lot. So takeaway for everyone listening, 100% do not pay it down early and use that extra liquidity to build wealth.
Yeah.
Put simply. Right.
Yeah.
All right.
Yeah.
You will be wealthier
Right.
by doing it that way.
Yeah. But you got to stay invested. It's got to be, you
Yeah.
can't take it and put it in a savings account. It's got to be invested in a market.
I think that's key. Right. Right. It can't just sit there and rot away in a savings account. Well, I think that ends it right there, guys. Everyone listening, thank you for joining us today for another episode of Wealth Wisdom. If you've ever wrestled with this question of whether to pay it down early or not, we hope you found this valuable today and provided a clear framework for, how to think through it. So if you're ever wondering what this decision looks like in your personal plans, we're always here to help. You can always reach out to us, foxhillwealth.com, schedule a complimentary consultation, or just email Eric or Bill at hello@foxhillwealth.com. And of course, hit that subscribe button so you don't miss the next episode.
Yeah, we actually have some Excel sheets and things like that where you can input this stuff and see the numbers, right? So it can be a very powerful tool. So we're happy to share that stuff.
Awesome. All right, guys. Well, until next time, we'll see ya.
All right.